Hello, this is John Piper with the first, what I'm calling a video webinar. Essentially a webinar in video format, makes it somewhat easier to prepare. This means the only difference really is that you can't actually ask questions during the course of this recording, obviously. However, you can leave comments below and I will answer these on a regular basis, or you can always email me if you prefer. And I will do my best to answer your questions. A word about myself: I've been trading since the 80s, did my first trade in 85, went full-time in 87. I used Elliott wave theory as predominantly as my analysis technique. It called the 87 crash beautifully, which was perhaps a bad thing as I became somewhat addicted to Elliott. It doesn't always give such wonderful signals, as I found to my cost later on. But it's been very interesting. I mean, at that point I was trading options, I then went on to futures, I've managed money, I'm trading virtually everything there is except maybe for pork bellies and orange juice. So I've had a pretty vast experience. I started writing books in the 90s. The Way to Trade is my first book and my bestseller, as it were. It's been translated into German, Chinese, Indian and Russian. So a fair bit of experience in the markets. It's funded a very nice lifestyle, and I'm here to try and help you achieve the same, really. The Think Markets, I'm also doing this obviously in association with the Think Markets, as you'll notice from the board. This is a risk warning. It's important to read this and be aware of what's going on. Financial spread betting comes with a high level of risk. It's possible to lose more than your initial investment or stake. Critically, only trade with money you can afford to lose. I'm quite saddened when I hear from people who've actually lost money which they had earmarked to buy a new house or some such, or people who in their retirement have been wiped out because they were trading in one vehicle far too excessively. It can be very dangerous unless you're careful. You must spread your risk and don't trade money you cannot afford to lose. So welcome to the webinar, which is Trading Psychology and the 10 Key Points. So I'm going to throw out a number of key ideas today. I'm also going to send you a free copy of my latest book, plus other bonus items. All you've got to do is to email me at srlist@aweber.com, and you will be sent an email giving you the links to do that. My new book is called The Way to Trade Better, and it's the sequel to my first book, The Way to Trade. Right, point 1, plan. Don't fall into the same trap as most traders. Most traders end up trading fairly randomly based on whatever input they chance on. This is not the road to success. A lot of input actually comes from our own brains. I'll look at that in a minute. But for example, many traders end up trading FTSE or the DAX. If you trade the DAX, you're in for a pretty wild ride. You trade FTSE, it's a bit quieter. But this year, most of my trading has been in gold and silver. I called a big bull market in gold and silver a little bit early, actually late last year. But this year it's more than doubled my account relatively easily. Now, I strongly recommend giving some thought to that simple point. What are you going to trade? Time frame is important. Are you a shorter term trader or a longer term trader? Are you a shorter term trader or a longer term trader? You're a tennis player, you may not play very good football. If you're a football player, you may not play very good tennis. It's important to understand your personality and to trade in a way that suits you. So planning sort of covers quite a lot of ground. It's a very important issue in being successful in markets. The brain. Now we also ought to have one of these. The instinctive brain comes from our long-lost reptilian ancestors. For example, the reptilian fish-like thing that crawled out of the ooze, the first great achiever, as I call him, but had predominantly an instinctive brain. There were no emotions, no thoughts. It was all about reacting very quickly to survive. T-Rex heads your way, you head off in the other direction very quickly. There's no time for thought. If you think, you die. So instincts are very rapid, and it's amazing how often the markets trigger your instincts. And even now, I sometimes find myself bailing out of a trade. Purely because of some instinctive reaction to some move, and you often end up buying the lows or selling the highs, which is not a great thing. What am I talking about? You very often find yourself buying highs and selling lows if you do that kind of behavior. The emotional brain is not as old as the instinctive part, but it's still very well established. And emotions are a little bit slower. little bit woolly. I mean, very important, obviously. We live our lives and our emotions, really. So a very key part of our lives. But the thoughtful brain is where we spend most of our time. Thoughts are far slower. Think about buying a car. You can think about it for months. But the instinctive brain probably has a very clear idea what it wants. The emotional brain may like a sports car, for example. The thoughtful brain is thinking, well, should I buy something practical? Maybe should I buy something economical? And all this kind of thing. And it's a good example of the three parts of the brain in action. There are many other examples. I guess approaching a young lady or young man or whatever, trying to start a conversation is an example where various different parts of the brain don't necessarily react in a very helpful fashion. And I think it's fair to say that the human brain is probably not that well integrated at this time in our development. Right, so I've covered that. I think the thoughts can be called the baby of the brain. There's a very interesting article called The Troubled Trader by Tony Plummer. It's actually appeared in my book, The Way to Trade, and you'll get this article if you email me, as I said, at srlist@aweber.com. The article actually classifies. We all have a dominant part of our brain, be it emotional, instinctive, or thoughtful, and this article classifies each of these types. So the article classifies each type. There are three variables. I think there are about 9 types, I guess, in the 3 different positions, and each one is affected differently by the market and has a different characteristic. And this also applies to the world outside the trading arena. People do react differently, and one way of classifying them is actually by this method. So it's a highly interesting article. I suggest you read it. It is quite technical. It's not a simple matter, but then you wouldn't expect it to be, given the behaviour patterns of the human race. So the various aspects of psychology and trading: our own brain, which is obviously critical. The market itself is a maelstrom of human psychology, a true crowd. There's also the media, which is always looking for stories, the more dramatic the better, and these feed through into the market. But the market is much quicker than the media, and once the media say something, the market will generally have digested it hours or days ago. So trading off newspaper reports is not generally a very good idea, but of course getting the news in the split second it comes out can be a way of trading, although many of these things are just knee-jerk reactions, and if you look at major news items, often the markets then back where they started from a few days later, or even a few minutes or hours later, which of course is a trading system all in itself if you think about it. There are also many ways of looking at the market: Elliott, moving averages, price spikes, market profile, etc., etc. And most people just drift into one or the other without really giving it any thought. So again, better to plan. What sort of trades do I want? What method will suit me best? But to my mind, novice traders are best using a system initially, whilst they grapple with the psychology issues, because a good system will keep you safe. In this regard, I am the creator of the A-B trading system. You may have seen it marketed here and there. I'm not trying to sell anything this webinar, but I do think a system is useful, so you want to choose a system which suits you. And of course, you can try A-B with no risk. First 30 days as a money-back guarantee. So obviously, I know that one best, so I will mention it again probably. But feel free to choose whatever you want to. Okay, point 2. The markets produce endless opportunities, but what's your time frame? Short term, medium term, long term? So as I said before, you're not going to play a good game of football if you're really a tennis player. Similarly, if your mindset is very short term, then trying to play the swings may simply not work. Point 3, which is the right market for you? Say in 2016 I made a lot of money simply buying and holding gold and silver. Very simple. Index trading and FX can be far more complex. So choose a market that makes sense for you. If you can see that there's a very determined trend in one or other market, then trading that trend may make a lot more sense than trying to trade, say, the Dow at the moment, which has been drifting sideways for 2 months now. Finally, you're a range trader. I'm recording this incidentally in the end of October 2016. So if you look at a chart, you'll see that the Dow and actually has just been going sideways, as have other markets. So something to bear in mind. All right, point 4. Wait for the trades with amazing risk reward. Too many traders feel compelled to trade even when the opportunity is not good. Wait for a trade. I know some people feel that if they're a trader, then they must trade all the time because that's their business, that's their job, that's their business, but that is not the way to trade. It's completely the wrong way to trade. Wait for the right opportunities. If you take my system A minus B, probably trades about 10-15 times a month. It waits for the right setups. I mean, it has clearly defined rules, so you know just what to do, when to get out, when to take your profits, and everything is clear, and there are stops in place so that you don't lose too much. You can manage your money correctly. So this is all important stuff, and any good system will do that for you. Point 5. First point, be consistent. The best way I know of doing this is starting out is to develop or acquire a trading system. I say a system simply applies the best rules. It's actually best to develop. I actually would suggest you develop a system. However, that can be difficult if you don't know very much about the markets. I mean, there is a sort of chicken and egg situation here. Once you know about the markets, then you can develop a system. If you don't know about markets, then it's quite hard to do that. But in fact, just simple observation could give you some ideas. Just look at the, I don't know, the FTSE or the DAX or gold or whatever, and just think about a few things. You could use the opening 5-minute bars. That's one well-known system. Do some testing. Check out the rules. If you want to buy a break, trade bar length, use the other length of bar as a stop, then just check it out. See how it performs over 30 trades. And you can actually develop a system without too much hassle. It requires work, of course, but then successful trading always requires work. Without a system, our psychology will drive us to fairly random action. Having said that, our psychology will tend to drive us to break system rules, but at least we can see that we're doing that. And that is another key point here, because I say psychology is all important in trading. Unless we have a system, then we don't really know what we're meant to be doing. So anything we do will seem to be okay, but if we have a system and we're not trading it, then at least we can see that things aren't working the way that perhaps they should be working. So that's another reason to use a system. As I said, my primary advice is develop your own system. All successful traders do that, actually. Not initially necessarily, but by the time they become successful. So point 6, market psychology. It helps a lot to understand some of the basics. For example, when everybody is long, the feeling is very positive. But the market has to go down, there's no one left to buy. A good example actually is the FTSE and Nikkei Dow peaks around New Year's Day. I think this happened in 1989 in the case of Nikkei, 1999 in the case of FTSE. And of course this is what you'd expect if you think about it. The markets are a maelstrom of human psychology. What is the most positive day in the calendar? New Year's Day. What is the most positive day of the millennium? The last day of the millennium on New Year's Day. So naturally that's when FTSE peaks, and you often do see peaks either in December or January, simply for that reason. It's it's just that's when everybody's very positive. So that's why the markets are very high, generally at that time of year. Point 7, education training. Trading is one of the most competitive arenas on the planet, so study your subject. Of course you already know that because you're here at this video webinar. It's quite interesting really, because people, if they want to play bridge or tennis, they're going to have a lesson generally. But many people enter the market with really no training at all, which is quite curious when you give it some thought. Money management systems is point 8. Simply put, if you risk too much on each trade, you're wiped out and never get to learn the business. As an example, if your system has a 50-50 success rate, which is fine as long as it makes more than it loses. So if it wins 1.5 and it loses 1, i.e. 50% more than it loses, then that system with 50-50 will make money. So that's fine. But what you have to bear in mind is that if you do 1,000 trades, the law of statistics means that within that 1,000 trades you'll have 10 or 11 losses in a row. Okay, so if you're risking 50% on every trade, then you won't last very long, because you only need 2 or 3 losses to come along and you've pretty wiped out your capital. So my general recommendation is 2% to 4% of your trading capital to risk on any one trade. Having said that, if you're just starting out, you may sensibly not use too much money in the markets. Often the first pot you put down into the market gets absorbed by the market, so you lose it, It doesn't hurt to start off with quite small sums to learn the business and keep some cash in reserve so that when you can start again, at least you know a bit more about what you're doing. Point 9, seeing the trading psychology at the key buy-sell levels. Buy-sell levels. Support and resistance levels are key. Understand the logic of price acceptance and rejection. Now, you'll have seen price spikes. Price spikes are one of my main techniques. You see the market leap below 100 level, so say the DAX goes below, 10,000, goes down to 9,970, sorry, let's say 9,980, and then it jumps right back again in a matter of minutes. Now that is rejection. The DAX has tested below 10,000 and it's been rejected. You've seen buyers come in and bump it back up again. That's a good buy signal, and it's important to understand the logic of that and what's happening. And that's called rejection. Now, acceptance is when the market actually accepts level, so it goes down below 10,000 and it stays there and starts trickling down lower. I found with extensive research that the 66, 77 levels on the DAX offer quite good support. So if I'm long the DAX, then my stops are usually below that level. Depends on where the spikes are. If there's been a spike down to 80, then I may get on 66. It depends on what I'm doing. If it's a long-term trade, I want to stay with it, then I will use a longer stop. Shorter term trades a bit tighter. Point 10, don't spin your wheels. The biggest mistake all traders make in my experience is they don't run profits enough. What happens is that the trader gets a bit of a kicking by the market, gets a bit frightened, uses very tight stops, also is desperate for a profit and will just jump on any profit they see, take the profit, they end up with small profits and small losses, and so it just is a pointless exercise. It can take hours and hours, but all they're doing is losing a bit, winning a bit, losing a bit, winning a bit. Doesn't get you anywhere, and you sort of die the death of 1,000 cuts. So you must run your profits. That's the secret to success in the markets. Point 11, what is the key factor that all winning traders share? And I'll tell you that after an example of a couple of recent trades. Okay, here's the chart of a DAX. I bought the DAX today, and just to show you why, you can see that they had these 3 spikes there. Actually, I write options on the DAX, so I was actually hedging the options. So I bought around, I think, just above 107. Not the greatest trade. No, sorry, it's about 168, I think. I had my stop down here originally, and now moved it up to around here, I think. Not looking fantastic. We broke the new highs, well, briefly, dithering around, so it's a bit of a iffy trade. I'll raise stop again to here if that rally continues. For the only trade I did today, but have a good look at gold. I mean, gold's had this big rally here, so it's been a substantial move. Now I've seen a correction, A, B, C is Elliott wave terminology. That's an A wave, B wave. Now 1, 2, 3, 4. Notice how it's hugging this 200-day moving average. It can't break above it, which is a negative. I think one more decline, 5th wave. I think the 50% level, 50% retracement level is around here. So what I'm expecting is a move back towards 1200, which could be a great buying opportunity. I'm counting this as a 1, 2 with an explosive 3 to come. No guarantees, of course. We have the US unpresidential election, I call it, because of the antics of the two candidates. A bit of a joke, really. In fact, if you want a good comedy interlude, then the unpresidential debates are quite good value, I think, on that score. But right now, it's looking pretty good for a decline. I prefer not to really, because I'm quite well positioned already. But a fall back to there would be good. Not impossible, of course, we go further, which would not suit me at all. Anyway, that's the current position, and if you're interested in gold and silver, then I think now is the time to start looking at it, because I think we could have a good opportunity coming up quite soon. Okay, right. So what do all the good traders have in common? And that is that they've all developed their own winning strategy and operated in a personal way. So when you find your own winning approach, it may bear no relation to mine, but it will share key characteristics, for example, an edge. As I said before, the A-B system is a great little system. Please drop me a line, and I will happily give you some details of that. My contact details are coming up. Okay, so if you want any details from me, just email me there for the free book, etc. Email that address there. You receive an email, just confirm. You actually get an email asking you to confirm you want to join the list, because an anti-spam measure, so that we don't send stuff to people who don't want it. Once you've done that, you'll get an email which gives you links to the free book and the article, The Troubled Trader. And if you don't want to be on the list, then just unsubscribe. It's very simple, as it's all automated by aweber.com, and we certainly don't want to send emails to people who don't actually want them. Right, finally today, I'll just give you a quick preview. A quick preview of session 2 back in 1985. When I started, you may think you have problems now, and of course all traders have problems they need to overcome, which is a very worthwhile process. I would have to say you learn a lot about yourself. Perseverance is a key factor here. But there was no internet, no smartphones, barely any computers, no charting software other than services like Reuters and Bloomberg at thousands per month. I think I actually signed up for Telerate for a while. That was about, I think, £1 a month. The minimum trading size is about £25 per point for futures and £10 per point for options. Very few good books available. I think Market Wizards was about all that was around in the 80s. Very few to zero good UK trading services until, of course, I started my own in 1989. So things are very different. I mean, things I think are much better now, but they're more competitive now. Far more traders around. And we're discussing all this in session 2, which I'll be recording very shortly. So finally, just thank you very much for listening to this webinar. I hope you found it interesting and useful. Please leave me comments. I'm always happy to have discussions. I mean, I know there's a lot of skeptical people around, but it's really nice to help people. It's something that makes life worth living, I think, or one of the things. There are many things that do. So this is a free service. We're not asking. There's no money involved. Obviously, buy the system there is, but then that's an optional choice. And as I said before, it's better to develop your own, but it's hard to do when you're starting out. And with that again, and bye for now.